Less than 2 minutes here until the closing bell. We have Leggi, the portfolio manager at ARK Invest. We're also joined by Ross Mayfield. He's an investment strategy analyst at Baird, and our very own Jared Blickery joining our Around the Bell conversation. Jared, let me just toss it to you first. We're seeing some selling pressure today in the markets. All three of the major averages in the red here into the close. What's weighing on the broader markets today?
Well, the official reason might be the failure to get through those direct payments of $2,000 today. Measures tabled. We'll see what happens. I don't think it's going to go through. I don't think many people think it will. But let's check out the price action for the day, because this is really a muted, low volume environment. I know this is a Santa Claus rally, the third official day. We're supposed to see some gains here, but the losses are pretty small. We're talking about the Dow off 55 points here, the NASDAQ off about 40 basis points, and the S&P 500 only off about 0.2%. Russell notably down 1.8%. It has been the high flyer this month. You check out over the trailing month, it's still up 5-6% here. Some nice gains coming back in the fourth quarter. Here's quarter to date for the Russell 2000, up 30%. But just looking into the NASDAQ 100 components, we can see the mega caps are off today. That's probably a reason we're seeing some weakness in the indices, even though we have other sectors trying to outperform. Healthcare is up 0.4%, and discretionary up about 4 basis points here, coming into the closing bell. And here it is on Wall Street.
And that's a wrap. We've a few sessions left in 2020, but right now we're waiting for the S&P 500. It'll settle down about 7 points. Dow will settle around off about 50 points. NASDAQ will be off about 50 points as well. Russell 2000, though, we've been watching the Russell 2000 cut the rotation, small cap. It's going to settle off by about 35 points. Then the sectors, just want to let you know that consumer discretionary was in the green, as was healthcare today. Utilities were essentially flat. Everybody else was off today. And one of the big ones that was down, industrials, information technology, those sectors off as well. Let's go to our guests, and let's start with Ross. I wanted to ask you, you referred to stimulus as a nice to have, but for Main Street, a must have. Does that mean when we get on the other side of this pandemic and people are back at work, that we'll see a pullback in the market because those folks won't have the money from the government to juice spending?
No, not necessarily. In the sense that stimulus is a nice to have for the stock market, mostly that, I mean, it really isn't a big, juice to the market. The market is able to look forward, look past kind of the next 3 to 4 months of vaccine distribution, logistics there, and any issues that might come from the coronavirus. But for, the people on the ground, small businesses, people, struggling with job loss or hours being cut because of COVID, this stimulus really provides a bridge. So for the stock market, which is, a forward-looking mechanism and gets pulled by different levers than the real economy, it's a nice to have. Nobody's going to complain about, particularly retailers and consumer discretionary businesses, people having an extra $600. But for Main Street, it was really a necessity to get through the rest of this pandemic.
Brendan, today we're seeing some selling pressure, but the bullish sentiment out there, it's tough to argue with. I mean, it seems like every day we're talking to people who are just getting increasingly bullish. Does this make you hesitant at all, given the fact that we're really, just yesterday, all three of the major averages closed at record highs?
No, this creates opportunities for us. We are long-term investors, so when we get increased volatility, market sell-off, sometimes our names are disproportionately punished because of these macro concerns. But that doesn't affect the fundamentals of the companies that we own. So it creates buying opportunities for us. We're focused 5 years out minimum on these disruptive technologies.
So follow up with us on the disruptive technologies, because right now it seems like tech might be dangerous or risky for a lot of people as we talk about the rotation to small cap out of tech. Are those people making a mistake?
Well, so we're focused on disruptive innovation. That goes beyond the technology sector. We're talking about companies that are technology enabled, that are really impacting all industries and sectors. And the pandemic has really accelerated the adoption for these technologies. And we've hit a point of no return, we think, for the 5 innovation platforms that we're focused on. So DNA sequencing, robotics, energy storage, blockchain, and artificial intelligence are accelerating. And we've experienced exponential growth in these areas. And we think this is a longer term trend.
Hey, Ross, what do you make of the recent moves that we've seen over the last couple of trading days? Do you think it's year-end profit taking or new thinking from investors? Because we've seen a bit of a rotation, and some of these names that have been outperforming throughout 2020 have been under pressure the last couple of days.
Sure. So over the last couple of days, it could be a handful of things. I think moving into 2021, a rotation into cyclical stocks and some of the more beaten down names probably makes sense, particularly if you have a shorter time horizon. I think that trade will work as the economy reopens, as we kind of get this wave of pent up demand. But as you were mentioning earlier, longer term, COVID-19 was really more of an accelerant for some of the secular trends that we're seeing, things like e-commerce, certain things like that. So I think there will really be a tailwind on those for longer term investors. And to your point about longer time horizons, I think you really have to consider that.
But what about the dangers with a weakening dollar, especially as we go into 2021? Ross, I mean, wouldn't investors be a little leery? Forget bonds, equities might take a bit of a hit because of that, wouldn't they?
Sure. I mean, certain names would take a hit from a weakening dollar, but on the large, particularly for say the S&P 500, a large cap index, that's global in nature. A weakening dollar could be a boon, and it certainly would be for emerging markets and international names. So to the extent that we recommend well diversified global portfolios, a weak dollar, in the near term is not something to be afraid of, and could actually end up being a tailwind, considering the way some of these indices are built.
Ren, speaking of emerging markets, are you seeing opportunity there? And if so, how are you identifying those specific opportunities?
Yes, we've seen a lot of opportunities. The two big pockets for innovation has really been the U.S. and Asia. So in Asia, more specifically China, we've seen a lot of innovation coming out of China, and that's been an area we've been focusing on a lot more. In fact, we've hired an Asian innovation analyst that is really picking apart that areas, and we're seeing opportunities in the EV space, in genomics, fintech. So we're starting to increase our exposure there.
Well, when you talked about, Ran, blockchain, a lot of the banks are putting together, the use of blockchain. Is there a way for me to get in on that as an investor without having to buy a bank stock? Is there another route I could go, or do I have to buy the financial?
So with blockchain, we're really focused on the public blockchain. So that's Bitcoin. That we think is as a store of value, or almost a neo gold, and we define it as a new asset class for investors. So we expect investors will start to gain exposure to this new asset class as a store of value, and start to take the place of gold in others in investors' portfolios. So that's the pure exposure is through Bitcoin, we believe.
Ross, I don't know if you're able to comment at all on cryptocurrencies or Bitcoin, but are you seeing any potential opportunities there?
Sure. So we definitely have conversations about it with our advisors, with some of our younger clients. I think that the way it was just discussed is certainly the case for value that we're seeing, which is a store of value. Something that's scarce, that's insulated from the quote unquote, money printing or control of fiat by governments. And that's the base case, or that's the investment case that younger investors and next gen advisors that we talk to really look at it as. And really what's interesting is, as a payment, it's a much more secondary consideration.
Ross, real quick, there was that article in the Wall Street Journal about margin debt being very high right now. And you were just mentioning younger investors, although the article had middle-aged investors in it. Any concern going to 2021 with that statistic, hanging over our head?
Sure. So, I mean, it's two things to me. The first being, extended margin debt. A lot of the other sentiment indicators that we look at are running a little hot, flashing some signals of concern. So in the near term, that's not, a cause for a sell-off, but it can accelerate, a contraction if something were to spook the market. So, that to me is emblematic of that trend, which we really have been seeing for, 4 to 6 to 8 weeks now. On the other side, which is, maybe retail participation in the market, the Robinhood story, which has been one of the one of the big stories of the year. My take on it is I'm all for the democratization of investing, and that's gonna sting people at times who get a little overextended. So it's concerning a little bit, but nothing to be overly concerned about to me, and maybe more emblematic of just the broader enthusiasm in the markets and investor sentiment running a little hot.
Right, Ross Mayfield, investment strategy analyst at Baird. Great to have you on the show, as well as Leggi, portfolio manager at ARK Invest. Thanks to you both for joining us.